Holding up well, you're watching closing trades right here on ET now. 24,300 is where we're currently at. While it's not been all that a steady session, we did dip into the red quite a bit and from there picked up about almost 0.5% or so. Under pressure today are some of those private banks which have been supportive of the market, not just last week, more so after the LCR measures got announced by RBI. So HDFC Bank lowered nearly by about 2%, Kotak Bank as well is down 1.7%, Axis SBI as well under pressure, and that takes care of a large weightage of the index in any case. IT, that continues its uptick. HCL Technologies after its numbers is perked up about almost 8%. Wipro is holding up about 5%. TechM, Infosys, these are all names which are looking very good. Indices as well, higher by 3% as we speak. So needless to say, technology is your big index performer today. Other than that, Tata Motors has made a very solid move. We're seeing an uptick of about a 4.25% there. And Jio Finance, ever since its numbers and the kind of breakdown that they gave on in their individual segmental performances, that stock has been doing very well, holding up 2.5% as we speak right now too. Important to check in on what the rest of the globe as well is up to, because that also is fairly buoyant. In fact, look how strong Europe is actually started in trade. It's a 3% move that you're currently seeing on the DAX. Equates to about a 658 odd point kind of move. You've got a 2% move coming in for the stock 600. FTSE as well is going very strong, and CAC as well higher by about almost 2.25% as we speak right now. So a strong show by the markets. Kunal, what's it looking like? We were a little wobbly though today.
Yeah, the start was a bit wobbly, but I think it's a good move from the indices that we are consolidating at current levels, and the fact that the Bank Nifty is showing that tad bit of underperformance, I actually believe that that's a very healthy sign, because then it gives other sectors room to move up higher, because you've already seen so much of short-term money being flown into the banking index and the NBFC pocket that it was more of a skew which was developing, that one sector is moving up higher, leading the charge from the front, and the other sectors were underperforming. So I think that should narrow the gap for the other sectors to play a catch up. But then this, when you look at this in terms of the sector rotation, I think it's a classical phase of a market rally, because you initially see one formidable sector moving up higher, and then followed up by other sectors which they play their part and then try to chip in when the leader consolidates. Net, we are still holding on to that 24,000 mark. We discussed this level a couple of days back also, that till the time we trade above this 24,000 mark on the index futures, that should maintain the bias on the much more positive side. And for the Bank Nifty, that level is 54,800 as a strong support in the short term.
Alright, so those are the supports that one can watch out for when you talk about Nifty as well as a Nifty Bank. We also have Dipan Mehta joining us right now. Very good afternoon to you, Dipan. Thank you so much for joining us. And yes, if you look at the way how the markets have rallied, 7 consecutive trading sessions that we've seen a good strong up move. Now we scale past the 24,300 mark. Is it time now to realign your portfolio or rejig your portfolio at this point in time? Because it looks like this sort of a rally or this up move will sustain now.
Yeah, good afternoon. Thank you for having me on your show. Yes, I think that we have a very strong and credible bottom. And now from this point on, the last few trading sessions have led us to believe that the best strategy going ahead is to buy on dips. And a lot of the concerns around Trump tariff now have abated. We will review all those tariffs over the next 90 days, depending upon where the actual tariffs fall and who is affected. But by and large, I think investors need to rejig their portfolio, rebalance it in favor of India-centric businesses. And the most notable development has been the hitting of the all-time high of the Bank Nifty. That's a clear signal that we need to be overweight the financials. That's the banks and NBFCs. This quarter, so far, the numbers have been good, and it will get better as the year goes along. And I think that a lot of factors are in favor of good numbers coming through from this industry, which is quite cyclical in nature, and we are in the midst of an upcycle.
I want to bring up HCL Technologies. That stock has been holding up very smartly. The fact that it was a revenue uptick of about 1.25%. Yes, the profitability did see a dip of about 6.2% on a sequential basis. But Dipan, the big question mark now is on IT. Is all the bad news factored in? We saw a sporadic move even after Infosys' numbers. Do you see signs of the sector bottoming out finally?
I think there are structural and secular changes for the negative taking place for the industry. any case, the track record for the past several years, almost 10 years or so, has been one of stagnation if you see point to point. And I think that every rise IT and software services companies need to be sold. First of all, there is the expectation of a slowdown in the US and global economy because of Trump tariffs that may subdue demand. Secondly, this rise of the GCCs, global capability centers, that also is driving a lot of business away from the software services companies. And this entire AI opportunity is not as big as it appears to be. So on the whole, I think I'd like to be underweight software shares, and such rallies are good exit points if you're overweight software.
Right, so that's the take coming in on the IT space, given the fact that today the IT sector is seeing a very strong up move, given the fact that it is seeing the best day in about 9 months, that is the Nifty IT index. But let's move on and let's talk about a big national news. And a day after India saw the biggest terrorist attack in the valley, Home Minister Amit Shah has visited the Baisaran meadows, where 28 tourists were gunned down by a group of terrorists who emerged from the dense forest. Prime Minister too cut short his Saudi trip and was briefed by the high-level committee upon his arrival in New Delhi. You also have the Cabinet Committee for Security meeting that is also expected later today. India is readying a rightful answer against this massacre. The sketches of the perpetrators have also been released and the manhunt is on. You have Defence Minister who also held a meeting with NSA as well as IAF. We have Sumit here with more on that.
So the high-profile Cabinet Committee on Security is slated to meet in the evening. What they are going to discuss, definitely a number of options are on the table. Well, in the aftermath of Pahalgam attack, the government has taken a very serious view of the situation. Ministers are here. PM has come back, so Cabinet can convene. FMC Taraman, while she is on her way back from the states, for that quorum is there of top ministers. That's why CCS can happen. Again, as we said, that a number of options are on table. They will be discussed. There can be diplomatic response to the whole attack as well. India and Pakistan already having the diplomatic ties at a very low level. Ceasefire is there between India and Pakistan at the border. There are a number of issues which can be discussed, ranging from stopping Indus water treaty or bringing it down, or to some other bring the perpetrators to book through other channels. So all this will be discussed at Cabinet Committee of Security, that's slated to be held today evening in New Delhi.
That's the latest on the Pahalgam attacks that we're currently picking up. In the meantime, let's get back to what the equity markets have been doing. Yes, technology is one segment which is holding out, but look at the renewed vigor across the auto segment as well. Look at a move on Tata Motors, M&M as well, holding out very smartly. Dipan, just wanted your sense in, I mean, of course, M&M has been one of those leadership stocks within autos for over a year now, but Tata Motors got a little wobbly for the last 6 months or so, corrected a fair bit in the market correction till Feb, and now, of course, concerns around tariffs, etc. as well at play. But how would you view Tata Motors? You think this decline should be bought?
No, I don't think so. I think that the impact will be severe, and maybe what we are seeing is some short covering, considering the markets have rallied, and now investors are looking for stocks which have missed out on the rally, and they are bidding those scripts higher, as can be seen in Tata Motors, and we have also seen the software services shares do well. Some of the FMCG companies also are performing well. So the laggards have started to perform, and that may suggest that this particular leg of the bull market, or whatever the upswing which we have seen, may be losing steam. And these are great opportunities to exit out of Tata Motors. There's a great deal of uncertainty around JLR. Even the Indian business is not performing as per our expectations and gradually losing market share as well. So although the stock is extremely cheap on a trailing 12-month basis, but there's a lot of uncertainty and slowdown of earnings going forward. So I would be a bit cautious.
Contra call though on Tata Motors.
Yeah, it would be very bullish on the stock. I think major part of the concern seems to be out for the stock now. It's already corrected from 1150, 70 levels to I think 500 or sub 500. There was a low for Tata Motors. So it's already seen a 40-50%, 50% plus kind of a correction. And when you see such kind of extremes in terms of price corrections, majority of the negative, they generally get, priced into the stock price. what follows eventually is not maybe a V-shaped recovery into stock prices initially, maybe a bit of a time-wise consolidation. But those price territories of 500, 550 mark, which is the low for Tata Motors, they generally become major bottoms for stock prices. And I believe in that sense, I would probably expect the stock to perform pretty well in the bullish stance. And even from a near-term play, I would look at least say 700 to 750 as a potential near-term target range.
All right, so that's a take coming in on Tata Motors. Kunal is pretty positive on this one. Deepan, let me get your view actually on white good companies. You have Havells that has reported numbers, cautious demand outlook. That's what they flagged off, and on back of that, you have the stock that has snapped an 8-day gaining streak. But what's your take on these white good companies? How are you looking at them, the likes of Havells or Voltas, for the matter of fact?
See, I think in the case of Havells, the numbers were pretty decent after many quarters or rather many years. We've seen good growth coming through, and that's because the Lloyd appliances business has done much better, and we've seen a significant increase in profitability over there. We are bracing for a very hot summer. So from that point of view, I think all air conditioning and air cooling companies should report good numbers, and there should be a lot of investor interest over there. But on the whole, I think that other appliance manufacturers seem to be fairly valued. But these stocks have underperformed, and we are seeing a rejuvenation of consumer spending on the urban side because of lower taxes and overall lower interest rates as well. So yes, you could argue that the appliance manufacturers may be in for a good upswing over the next few weeks and quarters. But our preference has to be for the air conditioning companies, the likes of Blue Star, or even Voltas for that matter. And then there are these contract manufacturers like Amber, which is there, which also should report very good earnings. But our favorite with usual disclosures still remains Symphony, which is India's largest air cooler company.
Stay with us. Lots more to talk about. For now, we're going to take a good, quick break. It's the breadth of the market, which is mighty impressive. So we'll address some of the buzzers on the other side.
Welcome back. You're watching Closing Trades right here on ET Now. We are building on the gains when you talk about the benchmark indices, with the IT sector taking the lead. Today, IT index is actually seeing an uptick of as much as about 4% or excess of 4%. It is the best day in about 9 months coming in for the Nifty IT index. We also have Nagraj Shetty joining us on the show right now. Very good afternoon to you, Nagraj. And given the fact that today you're seeing a good jump in the IT index, do you think that now is the time to position yourself in buying any of these IT counters, or at least the large cap ones?
Hi, good afternoon. IT has been in a sharp uptrend recently after forming an important bottom reversal. I think I'm expecting more upside is likely for the IT sector itself, as well as the main prime sector participants of IT on the upside.
That's about the IT index and how that one is looking right now. One of the counters that is in focus today is Aurobindo Pharma. It's got a US FDA nod for an anti-cancer tablet. And on back of that, the stock is actually seeing a good up move right now at near the day's highest point. That is Aurobindo Pharma for you. But Deepan, let me get your view on the pharma space as a whole, because this one also is a sector that has a maximum exposure when you talk about to the US markets, and also being hit with all these announcements coming in from Trump. How should one actually play this theme? And if at all, one should actually look at playing a pharma as a theme right now?
Within pharma, I think the best way to play pharma is to the CDMO companies, the likes of Divi's Labs, Suven Pharmaceuticals, Blue Jet, and then there is Dishman. There's also a new listing called OneSource. I think that the CDMO companies benefit from China Plus One strategy and some other regulation changes taking place in the US, like the Inflation Reduction Act and the Biosecurity Act. And on the whole, I think the opportunity for these companies is growing pretty well. Management commentary is very positive. The request for proposals has almost doubled as compared to a year ago or so. And optically, these stocks are quite expensive, but the earnings will be quite surprising. So since pharma has anyway got a very large weightage in the Sensex, Nifty, and the broad market indices, I think investors should have an exposure to pharma, but the best way to play it would be through these CDMO players. For other pharma companies, I'm a bit cautious, although India-centric company like Mankind Pharma is certainly on our watch list.
Okay, some of those domestic-facing pharma majors is what Dipan is actually looking at right now. But Dipan, anything that you may have added positions into? Of course, post the LCR guidelines, it's banks, which once again, you're convinced about increasing exposure to. But what has been your portfolio strategy?
Very much overweight banks and NBFCs, not just now, last 4 or 5 years or so. And we rode through the entire underperformance of the banks and NBFCs over the last 4 or 5 years or so. Right from the ILFS crisis, Bank Nifty and banking shares, NBFC shares have underperformed big time. Take, for example, Bajaj Finance, which is one of our top holdings. It went sideways for 5 years and now it has hit all-time high. So we were anyway overweight banks even when they were underperforming. And now I don't think there's any need to do any tinkering with those portfolios. We remain very positive on two banks, particularly if investors want to increase their exposure. One is IDFC First Bank, in which we and clients have investment, and second is IU Small Finance Bank. I think AU Small Finance Bank. I think both these companies, the risk return profile is great, and AU Small Finance has reported exceptionally good numbers. We expect the same from IDFC First, and we expect that these companies will trade at a premium to the banking sector over the next few quarters.
So that is IDFC First Bank and AU Small Finance Bank. Those are the counters that actually Deepan is liking when you talk about the banks in the NBFC space. Kunal, on the charts, how are both of these counters looking to you?
Yeah, I think IDFC First Bank is the one which is looking fairly attractive. I think at 66 or 67 where it's trading right now. The stock has confirmed multiple breakouts, and I think what's intriguing about IDFC First Bank as well as AU Bank, both of these stocks, they were huge underperformers over the last 2 years. They topped out much prior to the markets topping out from the September highs. I think the top out for IDFC First Bank, which was I think closer to that 100 mark, was closer to Jan 2024, and for AU Bank it was much prior to that. So I think in that context, the time-wise and the price-wise correction for these stocks have been steep. We're seeing a very good pickup of price action for AU Bank. Already the stock is up some 70-80 points in the last 10 odd days, back to that 650 plus mark. So I believe that both these charts are attractive. IDFC First Bank specifically something which I do track very closely and would be very bullish on.
One is seeing a long build up in AU Bank today. That stock has of course surged 9.25%. There are the technology names like we've been highlighting in any case, and Coforge, HCL Technologies. These are the ones which are actually standing out other than the large caps and what they're doing. KPIT, Persistent, LTIM. These are all stocks which are looking very, very smart. Look at what's happening for a delivery as well. That's looking good too. There's an Alchem which is holding out well. Lodha is higher by about 3.6%. There's a Bharat Forge which is looking smart. BSE has lapped up another 3% in trade, and that consistently has been hitting fresh life highs for itself. Dipan, we've talked about this often, but within the entire capital markets theme, what is it that you like still, and where is it that you think one can still add on to the counters?
This is where we are very positive on. And our top pick with usual disclosure that we and our clients are invested is 361. And I think that the recent acquisition is very positive. And overall, I think wealth management businesses do have less volatility in their earnings as compared to some of direct capital market plays like exchanges and stock brokerages. So we like that company. There's also Nuvama Wealth also, which is worth mentioning. Both these companies, I think, have great prospects. They are diversifying their offering, and the demand for wealth management is going to grow significantly given the wealth effect which we are seeing in the economy. So we'd like to play the capital markets or the stock market investment theme, or rather the financialization theme, through these two companies. Within the exchanges, we are particularly positive. Again, usual disclosure on MCX. And that's one company, I think, which benefits from higher options trading in the gold contracts. And the full potential over there is not realized. And its competitive position is very strong as compared to, say, BSE or NSE.
So those are some of the names that one can watch out for when you talk about the wealth management firm as well as exchanges. But on that note, thank you so much, Deepan, for joining us on the show. And coming to you, Kunal and Nagraj. Kunal, go first. What's your closing trades for our viewers?
So I'll again go with the contra buy and contra strategy over here. So Tata Steel is something which I would be bullish on from current levels. the stock has been a huge underperformer in the last, I think, 2-3 weeks. It's corrected more than 15 to 20% from those 180 levels, 170 levels thereabout. So I think at 140 odd mark for Tata Steel, this could actually turn out to be a good contra bet for a near-term target of close to 150, 155.
Okay, a buy on Tata Steel from Kunal. Nagraj, what's on your list?
I have two stocks. One is from CDSL, another one is from IT side, LTIM. If you look at the chart of CDSL after forming an important bottom reversal around 1050, the stock has been in a constant up run. Recently, it made a dip and moved up sharply, and now it has moved above the 200-day EMA. The overall chart pattern is looking positive, currently trading around 1354 levels. One can look to buy at this point of time. 1450 is going to be the target, and 1290 is going to be the stop loss for the trade. Second one, LTIM, L&T Mindtree. LTIM has been on a higher bottom and moved up very well in the recent 3-4 days, forming a higher bottom. Looks like the IT has formed an important bottom reversal and this stock as well. Currently trading around 4535 levels. One can look to buy at this point of time. 4800 is going to be the target, and 4400 one can place a stop loss.
All right, so those are some of the picks coming in from Nagraj as well as Kunal. But on that note, we slip into a break on this edition of Closing Trades. When we come back, last half hour of trading session.
Back with Closing Trades right here on ET now, and we're holding up quite well. The breadth of the market is well looking lively, and to add to that, you've got a good leg up coming in from the global markets. Europe has started off on a very strong footing, and the pre-market rates in the US as well so far are indicating to a big gap up move. But back to earnings for us, and FMCG major Unilever as well as Nestle are all due to report their numbers. So let me take it across to Snehi to find out first what her poll for Unilever is penciling in. Snehi?
Well, absolutely. So for HUL's quarter 4 FY25 numbers, we were expecting a rather muted set, but that's not surprising because even the previous quarter was like this. On the standalone year-on-year basis, revenue is expected to come in at 15,200 crore rupees compared to 14,857 crores, which is an uptick of 2.3% on a year-on-year basis. EBITDA is seen at 3,490 crores, which is a mild uptick of 1.6% year over year. Net profit is seen at 2,482 crores, which is up 3%, almost 3% on a year-on-year basis. It's the EBITDA margin that we're slightly worried about and going to be cautious about that because that is expected to come in at 22.9% compared to 23.1%. So a slight slip is what we're expecting when it comes to the EBITDA margins. Now segment-wise growth for home care, we're expecting to see slightly north of 3% growth. Beauty and personal care expected to grow by 1.8% year on year, and food and refreshment expected to be flat yet again. Just a 0.1% uptick is what we are penciling in for this segment. Lastly, let's talk about the key expectations. Largely a 10.4% a year-on-year decline is what we're expecting to see in other operating income on the back of the divestment of the Pureit business. Underlying volume growth is expected to be only at 1%, impacted by the price hike that the company has undertaken in its soaps and tea segment. And EBITDA margin also we're expecting some pressure because the royalty that the company pays to its parent Unilever has gone up by 10 bips. On the back of this, all eyes will be on growth outlook, inflation and pricing outlook, any commentary on rural and urban demand, and commentary on the demerger of their ice cream biz and their latest minimalist acquisition. But well, yes, all eyes will be on HUL's quarter 4 numbers. Largely muted set is what we're expecting.
For HUL, we're expecting a muted set of numbers in the quarter gone by. But Snehi, it's going to be a very busy day for you tomorrow. Definitely, you have Nestle also that will be reporting the numbers. So what are we penciling in for Nestle?
Well, absolutely. So similarly, a muted set is what we're expecting for Nestle as well, a rather muted to weak set you could call it. So on the standalone year-on-year basis, revenue is expected at 5,493 crores, which is an uptick of 4.3%. But this is the only segment, or rather the only metric where we're expecting to see any sort of positivity, because EBITDA is expected at 1,325 crores, which is down roughly 2% year on year. Net profit expected at only 860 crores compared to 934 crores, a sharp drop of 8% on a year on year basis. Margins are also seen to be heavily under pressure, 24.1% compared to 25.4% on a year on year basis. So 24.1 is what we're expecting. Lastly, let's talk about key expectations. The volume, which is the tonnage growth growth that the report is expected to be at 3%. Net profit is likely to be pressured due to input cost inflation as well as muted demand. The price mix growth is expected to be led by the price hikes that the company has taken in chocolates, coffee as well as Maggi, and sharp inflation in the likes of coffee, cocoa and edible oil are expected to weigh on margins. Finally, what will be important to watch out for when the numbers come out: volume growth and demand trends, raw material pricing as well, their pricing strategy, distribution expansion update, and the outlook on urban versus rural demand if they give this commentary at all. But well, yes, a muted set is what we're expecting from Nestle as well.
Okay, a muted set from Nestle. And thanks for that update on Unilever as well. Let's welcome on board Nikhil Ranka, CIO Equity Alternatives at Nuvama Asset Management, joining in on the show right now. Nikhil, hi, thanks for your time and good to have you on the show. Just wanted to understand, what's the market construct looking like to you? While of course we've come out of the woods, or at least so it seems, in terms of how prices have been moving, but still got that 90-day headroom for the tariff negotiations. Which way do you think Indian markets are going to be headed?
So, good afternoon, Aisha, and thanks for having me on the show. So, post the 10% odd rallies that we have seen from the February lows, my sense is the easy money is now off the table, and we are probably looking at a single-digit upside from here on. So, if you look at the period from post-COVID 2021 to 2025. One of the reasons why markets had that 17-18% CAGR was that earnings growth were very strong. We had double-digit earnings growth all through. FY25 was the first year where we had single-digit earnings growth after some time. And if you look at the Nifty returns of FY25, we were at close to 5-6%. Now, as we move into FY26 and FY27, we have this uncertainty of tariffs hanging over. And we've continuously been seeing earnings cut happening. So we started 3 months back with FY27 EPS estimates at close to 1350. And now the consensus has moved down closer to 1310 levels. My sense is, given the uncertainty that is going around, we will have further cut to these numbers. And therefore, if I put a 20 times multiple, we are probably looking at somewhere close to 26,000 levels on the Nifty 12 months down the line. And from these levels, therefore, it means that we will probably have single-digit earnings upside on Nifty from here on.
Okay.
In terms of tariff, I think, 90-day period is more for negotiations that, countries which had put some sort of tariffs, it actually gets ratified and US gets to low tariffs when they are exporting to these countries. My base case is that eventually the 10% tariffs will stay and we will have nothing on the reciprocal tariffs from there on.
Right, so that's a take coming in on the markets as well as the entire tariff uncertainty. Hi, good afternoon, Nikhil. I wanted to get your view actually on the IT sector, given the fact that today it's having a good run on back of the fact that you have HCL Tech's guidance that has actually perked up the street. But what's your take on the IT space? How should one actually play this theme, given the fact there's a lot of grey area right now?
Compare this period, if you go back in history, and what we did was we compared how did FY21 pan out for most of IT companies because COVID happened in March 20. And we saw that, Q1 and Q2 of FY21 were the 2 quarters there was very high uncertainty. There were 2-3% QOQ sequential decline in revenues of most IT companies. But for the full year, if you look at it, third quarter and fourth quarter, they bounced back very strongly, and very few companies had full year revenue decline for that year. My sense is that situation this time is not as bad as it was during COVID, because at that point there was complete dislocation. And the initial commentary that we have heard from the likes of Infosys or HCL Tech, the managements have clearly called out that they are just seeing some delays, but there are no deal cancellations. So once this tariff uncertainty subsides, my sense is in the second half of the year, typically seasonally it's a weak quarter, but this time H2 could be a bit stronger because the budgets which have been delayed in the first half could come up for spending in second half. And therefore, overall, although this will be a single-digit revenue growth year, my sense is we should still be fine. And remember, balance sheet problems are much difficult to solve. In the case of IT, most of the companies are cash rich. And the demand problem is probably a 1 or 2 quarter problem. The moment we see that coming back, valuations will start getting re-rated again. Infosys, which used to trade at closer to 22, 23 times, has today re-rated close to 18, 19 times. And similarly, for a lot of IT names, we are probably today one standard deviation below mean from where we used to be, say, 6 to 9 months back. So as certainty starts to come in, my sense is valuations will again start inching up for IT names. On an absolute basis, the downside looks very, very limited, but there could be some time consolidation in these names.
Interesting you say that, Nikhil. But what's your view then on the overall sectoral composition that one should have in one's portfolio right now? And I'm going to keep banks out of this because I'm guessing much like the consensus view on the street, banks, of course, do make it to your outperform list. But other than that, where do you think signs of outperformance, underperformance are currently visible within the markets?
I think metals and pharma should start coming back again. So metals, obviously, we've seen 12% safeguard duty coming through. So in that sense, that does provide a floor for most of the names in terms of pricing action. Even if internationally there is some pricing pressure on steel prices, given that one, raw material prices have come down, and second, there is that cushion of safeguard duties. I think there is a natural protection for most of the metal companies, and there is a dollar weakening trend also going on around the world. DXY used to trade at closer to 109 levels a month back. It is now closer to 100 levels. So typically in such a macro backdrop, metals tend to perform very well. And secondly, if you look at pharma also, given the uncertainty on tariffs, a lot of pharma names did underperform, but my sense is, given the fact that almost 50% of the generic requirements of US is being met by Indian companies, and the fact that margins are not very high in generics, it is unlikely that we will have significant tariffs coming on pharma companies. And once the uncertainty on that part settles, my sense is investor interest will start coming back on pharma names as well. So these are the two sectors I think that they start performing as some sort of visibility on tariff starts to come.
All right, so that's the take coming in on the pharma space as well as the metal space. But let's talk about the banking space, because you have Axis Bank that is now all set to report its Q4 numbers. Gaurav is here to tell us what the street is penciling in for Axis Bank. Gaurav, over to you.
Well, yes. When it comes to Axis Bank, we are expecting advances to grow somewhere in the range of 9%, while deposit growth could remain somewhere in the range of 7 to 8%. And as a result, when we talk about net interest income, it is likely to grow somewhere in the range of 6% on a year-on-year basis. When we talk about other income, usually Q4 is stronger for other income. But given that there are expectations that there may be some slowdown in loan book growth for Axis in Q4, we may see a lower fee income this quarter. And as a result, when we talk about PPOP, it is expected to grow somewhere in the range of 4 to 5%. When we talk about provisions now, there are no major concerns about the asset quality, but credit cost is likely to inch up to normalized level of 0.9%. And as a result, when we talk about profitability, now street is expecting profitability to decline almost by 4% on a year-on-year basis, although it may remain healthy with a growth of around 6% on a sequential basis. When it comes to net interest margins, now street is expecting some kind of softness in net interest margins because of the EBLR linked loans, and second is the change in loan book mix. So definitely a 3 basis point of fall is what they are expecting. But let's not forget that the peer banks have already reported some uptick in net interest margins, so definitely there is a scope of positive surprise here as well. In terms of the commentary, loan book growth and deposit growth commentary is definitely something to watch out for, and it is also very important to see how bank is commenting on the margin outlook for FY26. But definitely on the back of the numbers, we are expecting good set of numbers with some expectation of positive surprise from Axis Bank.
Okay, that's the take coming in on what to expect from Axis Bank right now in trade. But Nikhil, just wanted your pecking order within banks, and other than ICICI Bank and HDFC Bank, would you say look at some of the bottom-up stories, look at PSBs, or would you say stick by with the large private bank players?
So Aisha, I would say on the private bank side, a lot of sort of multiples which had got compressed when the liquidity situation was bad, that has got normalized. So, 3 months back, if you see the banking system was in a deficit of close to 3.5 lakh crores. But post the new RBI governor coming in, there's a complete change in stance. We've seen a lot of OMOs happening, and the system is back to neutral to surplus levels. And given that backdrop, a lot of the large cap private bank names have now sort of gone close to where they historically used to trade at. I think there could be some catching up that could happen on the PSU bank side. And my sense is on the MFI sector also, based on our interaction, we feel that this quarter could be the peak asset quality stress for MFI banks. And from here on, as we head into Q1 and Q2, things will start improving materially from these levels because typically by their nature, MFI are short tenure loans. And so whatever stress has to get accounted in 2 to 3 quarters, everything gets accounted. So post this quarter, I think there could be an interesting entry point for some of the MFI names as well. And investors could look at those names from a 9 to 12-month perspective.
Okay, that's the take on banks. But what about the rest of the market? We spoke with Harold Vanderlyn today from HSBC, and here's what he's making of the global setup and how India is positioned amidst that.
We've seen in India, of course, is that growth is actually slowing so far, actually, through the result season. It's so far the guidance has been a little bit better than I would have anticipated. But let's see what happens. But growth is slowing, but still the feeling is that structurally growth in India over the next couple of years should be okay. It's maybe earnings growth somewhere between the 10 to 15% or so. And in the current kind of global environment, that doesn't look too bad. What do we need to see really to get more positive? Now, we actually were quite cautious on India 12 months ago. Not so long ago, we said, listen, let's be neutral because we think that's a little bit more balanced because a lot of the things that we were worried about to a certain extent had already been priced in by the market or had faded. You have, for example, valuations lower. The realization that the earnings growth is not going to be as fantastic as it were over the last 3 years is now well priced into the market. Also that you have some policy support that can come through that can be good for the market. So in that sense, India starts to look a little bit better from here on. The sectors that we talk about with foreign, mostly for investors, is to a large extent large liquid sectors where valuations are reasonable. So you end up with the banks very often, private banks in particular, or where valuations are maybe a little bit more elevated, but where at least the growth story is relatively macro insensitive in the sense that, for example, is dependent on demographic or slow shifts in society that even though interest rates go up or down, don't really change that much. Think about, for example, rising consumption or, for example, demand for medical and healthcare in India, such as hospitals and these sort of things. So those are the sectors where we look at as well. So bank, consumer, and I would say selected but domestic healthcare.
All right, let's talk about the banking space, given the fact that this one has seen a lot of action, especially on the regulatory front as well. And you've seen a lot of respite coming in for the space. You had HDFC Bank, you had ICICI Bank report good set of numbers, and post that also you saw an up move in some of these counters. We spoke to Rahul Jain, who is the head of APAC Financials and India Equity Research at Goldman Sachs this morning. And he said that they're expecting the credit cost to peak out in the next 2 quarters. Hear out his views.
As we start to look out into this financial year, we feel that the sector actually will start having better visibility on its profitability over the next couple of quarters. This will be on the back of 2 important variables. One is the credit cost. So for the last 2 years, we've been quite cautious on the unsecured lending across different segments. We clearly see that starting to peak in terms of the a pain point for the banking sector. And that will mean that over the next 1 or 2 quarters, the credit cost will start to peak out for the sector. And also on the margins front, given that the Reserve Bank of India started cutting the repo rate, we feel that most of the impact on the margin should be reflected in by the second quarter. So by second quarter, we expect the EPS cuts to start bottoming out. And there, getting to your point about the start of the earnings season has been rather good. The lenders have managed to maintain their profitability, and we've already seen the cut in savings rate, etc., which will also support the profitability. The impact of the NIMs would be well absorbed from the policy rates. From the investor standpoint, they clearly seem to prefer the entities that can produce predictable earnings quality and stable profitability profiles. So clearly, I think the private banks and NBFCs are being preferred by the investors that we are speaking to at this point of time.
Okay, that's largely the overall view on the markets right now. Lots of earnings that we're going to be tracking come today as well. But for the day, it's really technology, which is where you're seeing the big movers. Other than that, Nikhil, just wanted to understand whether there are any contra plays in the market right now. What I see is some of these globally linked auto ancillary sectors or stocks as well are moving out. You've got a Bharat Forge, a Tata Motors, Sona Comstar, which are seeing some decent traction today. Anything that you would go by?
So we are a bit cautious on the auto space, Aisha, predominantly for two reasons. One is, if you look at it, there is a possibility that margins could come under some pressure. So if we have steel prices moving up because of the safeguard duties, given that the demand scenario is extremely weak, my sense is it will be difficult to pass on the entire cost push. And to that extent, there can be some pressure on margins in the near term. And the second is, if you look at the sort of inventory in the channel, the inventory in the channels is pretty high. And therefore, unless we see secondary sales picking up, incrementally to push primary sales will become extremely difficult. And therefore, when we see the volume numbers getting reported over the next few months, my sense is the street will start getting disappointed with that. And so on the auto side, predominantly, we feel that stocks can consolidate here for some time or can even move a bit lower from the current levels. On the auto anch side, I think, as the uncertainty on this tariff subsides, because a lot of them have global exposure, those stocks had come down quite a lot. And now with things stabilizing a bit, those stocks are doing some bit of catch up. But globally, if you look at the charts of any auto companies, be it Volkswagen, Daimler, Chrysler, everything has seen 30-40% decline over the last 12 to 15 months. So globally also, the auto industry is not in a very good shape. We saw the commentary from a lot of IT companies also, which are dependent on autos, that they are seeing some sort of demand slowdown over there also. So auto is not one of the sectors which is in our preferred list right now.
Coming on the auto space, but Kunal, I wanted to get your views and your actually BTST idea for our viewers.
So there'll be two buy calls. The first one, which I'll be suggesting, would be a bond DMart. That's a stock which I think is now making a comeback. It's back again to that 4,500 plus levels. So I think looks attractive for 47.50 as a target. Stop loss could be kept at 43.50. And CDSL is the other stock which I would suggest, as a BTST play. The stock is heading towards a Bollinger Band breakout as well as a range breakout about 1350 plus mark. So 1500 as a target. Stop loss at 1300 for CDSL.
All right, so those are some of the BTST ideas coming in from Kunal, CDSL as well as DMart. You did speak about the auto space right now, actually, Nikhil, but I just wanted to get your view, especially on the auto anch space and a detailed one on that. I believe you spoke about that as well. You did touch upon auto anch as well, along with the auto space. But let me talk about the realty space then. How is that one looking to you, given the fact that, yes, let's look at domestic-oriented stocks or the sectors? That's the call coming in from most of the experts. What's your view on the realty space? And are you also in the camp that you should look at realty space right now?
So if you typically look at it, whenever we have a very sharp dip in markets, real estate typically is at the receiving end because, real estate sector is something where, the wealth effect plays a lot in that sense. So typically when you are in the last stage of a bull market, those are the times when you see the peak of the real estate cycle in that sense. And in this time, last 6-7 months, given the sort of wealth destruction that had happened in the markets, Real estate stocks had also seen 30-40% fall. But my sense is in terms of pre-sales, in terms of launch pipeline, most of the names are on track. And the second biggest advantage is this time around, if you look at the balance sheet of a lot of real estate stocks, the balance sheet is in very good health. Most of them have cash on balance sheet also. And for some of the names, like DLF, Prestige, Commercial now accounts substantial 30-40% of their overall SOTP in that sense. So given that backdrop, because that is a more defensive part of the segment, overall valuations would not compress that much. And after a 20-25% drop in most of the names, I think there's reasonable value that is there in most of the names from these levels. With a 12-month horizon, given the fact that we don't feel markets will go and retest back that 21,800, 22,000 levels, real estate should do okay from here on.
Coming in on realty right now. Today, of course, the big buzzers are really from within the IT pack. Metals as well is seeing some sporadic moves. And selectively, you're seeing Pharma, led by Sun Pharma, also hold up quite smartly in trade. The underperformers today are oil and gas, cement, telecom, and some of the private banking, or rather, I should say, large cap names are the ones which are relatively quiet in today's trading session. Add to that some of those infra plays as well. Nikhil, what's your view on infra as a pack right now? They too have corrected quite a fair bit in the recent market fall, but anything that you think domestic linked could be interesting at this juncture?
So Aisha, what had happened was, if you look at the FY25 capex budget of government, that was close to 10 lakh crores. And if you look at the spending that had happened in the first 9 months, the spending in the first 9 months was very, very weak in that sense. And therefore, people got concerned about the order inflow numbers for a lot of these companies, as well as there was some delay in payments as well because of the populism of schemes that had come through. But as we have moved into Q4, we've seen a substantial pickup and spending that has happened from the government side. I mean, Q4 to Q4 YOY growth, if you look at in terms of capex spending, it's in excess of 60%. And because of that, I think the stocks will start to see revival once again. In the case of, probably Larsen, one of the apprehensions that the street will have is Larsen does have international exposure to Middle East. And with oil prices coming under pressure down to 62, 63, there could be some spending cut that could happen from these countries, and that could reflect in international order backlogs. Having said that, my sense is for FY26, the spending should be more even across the 4 quarters. It should not be very back-ended. And therefore, we should not have that concerns on the infra names going forward.
All right, so that's the take coming in on the infra space. On that note, thank you so much, Nikhil, as well as Kunal, for being part of the show and talking about the strategy that one can adopt actually in this market. If you look at the markets, we are shutting shop near the day's highest point, looks like it. And Snehi is there to take us through the closing trades.
Absolutely, shutting shop at the day's highest point, but that it hasn't been an easy way reaching here today, because at one point of the trading day, we were even struggling to hold on to the 24,100 print. Right now, looking comfortable about 24,300. So it's been a 150-point uptick coming in, and a slightly more uptick coming in from the day's lowest point is what the recovery is that we've seen on the market today. A 0.6% uptick coming in on Nifty. Sensex absolutely in tandem, and right now seems like it's above the 80,000 mark. Let's see what the last couple of minutes of trade hold for Sensex, and a 0.6% uptick coming in on Sensex as well. Let's look at Nifty Bank. This one has been a solid underperformer in today's trade after the kind of rally that we've seen. Fresh highs coming in back to back for Nifty Bank, live highs rather. Today the index is subdued, a little bit of 0.6% cut coming in. Nonetheless, above 55,300 is what we are seeing for Nifty Bank. Let's pull up the broader markets and take a look at what the action has been from the broader end of the market, because the advance decline ratio is only very nominally tilted in the favor of the advances. Today you have Nifty Mid Cap. That's also seen a stellar recovery from the day's lowest point of 1.1% uptick coming in on an intraday basis. Nifty Small Cap too following in tandem, and good moves coming in for Nifty Small Cap as well, but slightly subdued, a 0.5% uptick coming in. So small cap has not been able to recover all that much from the day's lowest point, but mid cap and the Nifty and Sensex, all three of them have done pretty well in today's trade. HCL Tech is the stock to talk about today on the back of its quarter 4 earnings coming in. Almost an 8% uptick coming in on HCL Tech, and it's not only HCL Tech's name like Coforge. You have Coforge that was up by 6%. You have LTI Mindtree, Tech Mahindra, Emphasis, Persistent, Wipro, Infosys. All of them have held the Nifty IT pack very high in today's trading session. That's the big winner of today. You have Tata Motors, M&M that have also done well, Hero Moto as well. So the auto pack was also up in a buzz in today's trade, which makes IT and auto your top 2 leaders, followed by Pharma, Realty, Metal, Energy, FMCG. On the flip side, your financials that have been leading the market for the last couple of trading sessions were in the red, with Nifty Financial Services, PSU banks and banks closing in the red. But that's how we're shutting shop for the day. We'll give the rates some time to settle, but nonetheless 24 to 80. So we've slipped below the 300 mark, but that's how we've shut shop for the day.